Welcome back. Today we're going to talk about wholesale inventories and why they are so important to watch. Wholesale inventories represent very simply the goods that are sitting on the shelves. When there's rising inventories, it sometimes suggests businesses are stocking up for higher future demand. But conversely, when we see a decline in inventories, when we walk into a store and there's not a lot on the shelves, it sometimes does suggest that businesses are bracing for a recession. They don't want to make an investment if they don't see a possible return on that investment. Well, let's take a step back in time to the late 1990s. This is what the apparel sector looked like in terms of wholesale inventories. In late 1997, early 98, we saw wholesale inventories on a year over year basis hit a high and then quickly move to the downside. Apparel moved very quickly to the downside. Notice the white line S&P 500 did not hit its significant high until 2000. By that time, wholesale inventories had already gone down by a very significant amount. We can also consider the machinery industry. Machinery industry hit very significant highs in 1998, around the same time the apparel sector did, but very quickly returned to the downside even before stocks hit their significant highs. We could also consider motor vehicles and parts. Now, this sector in particular is important to watch because it certainly is very sensitive to high interest rates. This peaked a little bit after the apparel or the machinery sector, but nevertheless, while stocks were hitting the very significant highs, this sector had already begun to decline very, very quickly. So, again, it's important to watch wholesale inventories because they certainly can act as a leading indicator. So, while stocks are going up, wholesale inventories will tell us that the ground underneath our feet might be shifting. Well, today it was reported by Reuters. U.S. wholesale inventories fell for a second straight month in November, suggesting that a slow pace of inventory accumulation could undercut economic growth in the fourth quarter. This reported by the Commerce Department's Census Bureau. Well, this is today's report. Motor vehicles and parts. That's good on a year over year basis, up 11%. We see machinery. That's up 15% on a year over year basis. However, apparel, remember, that was one of the early sectors to move in the late 1990s. That is now down 23% on a year over year basis. Well, let's take a step back to 2007. We saw the apparel industry was quite strong. Nasdaq, S&P 500, Dow Jones Industrial Average, all major stock indices were hitting their very significant highs right around that same period of time, late '07, early '08. Wholesale inventories had already begun to decline. Notice by the year 2009, when the stock market really started to crumble, wholesale inventories were also crumbling and hit very significant lows in deep negative territory on a year over year basis. Also, the machinery industry, well, 2007, 2008, it had already begun to decline. This acted the same way it did in the late 1990s. Machinery moved ahead of the stock market. So by the time the stock market hit its very significant highs, we were in negative territory on a year over year basis for machinery wholesale inventories. And then finally, motor vehicles and parts. Very significant highs were hit late '08. This seems to be a late comer. This seems to move later than the other industries. It seems that apparel and machinery move faster. Nevertheless, it does show a strong correlation to stock markets. So we see here these different lines represent the wholesale inventories. This goes back to late 2021. In particular, we can see motor vehicles and parts. That's the green line. It's number two in terms of its strength on a year over year basis. But take a look at the overall trend. It is slowly declining to the downside. Certainly not encouraging. The overall trend is very weak. We could take a look at machinery. Remember, that's a little bit early in the game, too. That usually doesn't move until later on. However, we take a look at apparel. It has crumbled, absolutely crumbled to the downside. It's now technically probably on a year over year basis, the weakest sector within wholesale inventories. So, certainly something to mention. Altogether, we can see the trend certainly is to the downside. Some sectors are moving faster than others. Motor vehicles and parts, remember, probably moves later than all the other industries. Apparel seems to be more sensitive. Maybe it's because it's simply considered to be the most luxury of the goods. Now, if you have not already, please join us at our brand new Substack newsletter. We just published our first analysis. It's long form analysis. It's called the business cycle. We take a look at the 6 different stages of the business cycle, reflecting stocks, commodities, and bond yields, and what that tells us about our current economy. It is at the Substack website. You can join for free, no email required. If you'd like to subscribe, you can do that as well. Just go to substack.com and just very simply search for us there. Just the data. Make sure you include the underscores. Just underscore the underscore data. And as well, please also visit our Twitter page too, at justthedata.com. We hope this has been helpful. We look forward to seeing you back soon.